really first, like we put it LOI before when we were in Austin and smaller units, like 30 something. And it was we didn't know what we were doing actually. But this time putting in an LOI this time feels a little bit different. So welcome everyone, welcome Andy, welcome Bob, Sasha. I think Jason gonna join us today too.
Okay.
Yeah. So we also got help from Jason for the LI that he's using. So he sent us to us the form of the LI that he's using. So that super helpful. And yeah, we use that. So
Making big stuff.
what about your birthday week? How did you celebrate, Bob?
I went up to Chicago to visit with some old friends and went to a baseball game, among other things. And yeah, it was for lack of a better word, it was incredible. So I was glad I did it.
That's awesome. Yeah. And it's cool today in Dallas. It's cooler now. So we're like in fall or something.
Well, for some of the hot days we've had this year, I'm sure it's a welcome respite.
Um, okay. So let's wait a little bit. I think 5 minutes to get other people to join, and then we can. So what's up in your world? Just the holiday hanging out with friends and family? Anything related to investing that you want to share?
Well, for me, I was over at one of our single families that vacated on the 31st and gonna have to put some doors in probably later today. And so yeah, trying to turn that around hopefully in the next couple of weeks and get that back in the market. And the rates have went up substantially here. So we're looking, I want to say over $300 increase because we had that tenant for a long time. And
Oh wow.
yeah, so we're gonna take advantage of the market.
Uh-huh. So how long they there?
They were there over 5 years. And
Wow.
all in all, they left the house in decent condition with a family with two children and dogs and all that. Uh, there are some things we're going to have to take out of the security deposit, but generally happy with the outcome.
With how it looks after they left. Okay.
Yeah,
Okay.
and I suspect if we would have increased some rents only a smaller amount, they might have stayed an extra year or so. But
Mm-hmm.
let's see what happens.
Yeah. Yeah. We also tried to fix one of our house that the tenant just left, and I don't think they're gonna get any security deposit back.
Well, they didn't leave; they got evicted. So
They got evicted. Yes.
that's what happened there. Cool. All right, Jason is here, so we can switch gears from single family to multifamily, which is a much more interesting topic. So, well, yeah. First of all, Jason, thanks so much for sharing the LOI templates. I can talk more about like how we got here, and yeah. Sophie, you want me to start in any specific place?
Yes. Jason, are you here?
Yes, I'm here. How you guys doing? Hi, Sophie. Hi, Sasha. Can you hear me?
Yeah,
Yeah,
I
we
can
can hear
hear
you.
you.
Yeah, we don't see you, but that's okay. We have a really great picture of you. So
I'm in uniform right now, so yeah.
okay. Okay, we do want to see that at some point, please. But all good. So yeah, thanks for joining us, Jason. I can talk about this first LOI that I've ever put in at length, and we only have about 15 minutes or so. So yeah, what's a good place to start, Sophia? Recap, an update. How do you want to
Um,
play this?
I think you should share about, so LI is LI is easy. I think everyone kind of know, but how do you come up with the offer price? That's the important part, right?
Mm-hmm. Sure. Yeah. So I'll do a quick recap. We're talking about a 66 unit deal, 1975 build here in Dallas, south by southwest of downtown Dallas. It's a Class C neighborhood, Class C property. Uh, Definitely a value add opportunity. It's on the market through Marcus and Millichap. I've been underwriting this deal with Andy for a couple of weeks. Last Friday, so 3 days ago, was their best and final, I believe. So I've been in communication with the broker. Sophie and I walked the property a couple of weeks ago as well. And I did get an opportunity. So obviously I underwrote it, plugged in a bunch of numbers, moved them around quite a bit. But then last week on Thursday before Friday's deadline, I also met up with a friend and a mentor for a call to go over the uh, the deal, and so I can talk about the shifting of the numbers in that particular conversation because it was super super helpful to me. And please chime in with any thoughts you have. Does that sound good? Okay, I think that sounds good. So I see head nods. All right, I'm gonna share my screen. Recap on the OM. So one thing that we when I was going with this a friend of mine over the OM, one thing he noticed, which I kind of missed, is for their mechanical, the wiring was assumed copper, so it didn't actually say copper. So I've since clarified that it is in fact copper, and so that helped us uh, land on the right or more appropriate budget for the capex for rehab. So that was helpful. So let me.
So copper and no copper, what's the difference? Copper is good, right?
Copper is good. You don't want to have aluminum. So what this said is basically it could be aluminum, but most likely copper. We made sure that it is copper, in fact.
Ah, I see. I remember I flipped the house in New Jersey, and part of it was aluminum or something, and it was a cost to took it out and at the inspection when the buyer inspected it.
Yeah. So okay. So let me quickly talk about some of the things that we tweaked in here. So one thing that we did was we reduced the loan to cost. So even though we do have term sheets that put the loan to cost at a maximum of 80%, it made sense to take it down a notch by 5% and increase the interest rate by 25 basis points just to be on the safe side. So this was some conservative underwriting tips because I plugged in the exact numbers that came from a term sheet. So, but the advice was to have a little bit of slack in there. I bumped up the rehab from 360, which was 10K per 36 units that need to have rehab, to include more based on, again, plumbing potential issues. It's a 1965 property, so cast iron plumbing, and the potential need to upgrade some of not the wiring, but the electrical panels in some of these units, or have some money in reserve. So this was the thinking here. So that budget went up. The other thing that we changed was the the contract services. So we reduced contract services by focusing on just a couple of things in there. I think landscaping was one of the primary things, and trash. So let me pull up the interesting piece about trash collection. So if I pull up the T12, oops, okay, that's gonna open numbers. Okay, let's do that. If I pull up trash collection, okay, trash removal. If you notice, trash removal costs about an average of 2,800 a month. So when I look at these numbers, I don't, nothing really drives my attention, right? I just assume, okay, so that's what we pay. It turns out that $2,800 is how much a 200 unit property pays for in trash collection. So that's something that I would not have known without someone experienced looking at this. And so I followed up with the broker, and turns out that yes, indeed, they're overpaying for trash collection by a factor of 4. So the trash removal should really cost about $500-$600 here, and they do have a quote for that amount. So that's why I was able to bring this number down. The other thing I did was I increased the property management fee from, I had it at 35,000 to 45. It is a smaller property, so the number went up from 3% to almost 4%. So that makes some sense. Also, because we're offering less than the current less than the current tax valuation, I bumped this number up to 100 from 95% that it was before. What else changed here? I think that's about it. Yeah, that's about it. The other things that we changed here was this all became 3%. It was 2% for rent increase, but I put it at 3 across the board. So that's one item we bumped up. The other thing that we did was we increased the economic vacancy to 9. It was 8%, the way I had it. So again, just a more conservative move.
Hey,
And
so real
yeah,
quick,
go ahead.
let me
Yeah.
just so with that year one that projected economic vacancy, right? The one.
Mhm.
Yep, the year one. Now on the according to the T12, as you see right there, it's at 19.6% economic vacancy, right? So in year one, you kind of want to, adjust so that you're not jumping from 19 to 9, because that's almost about a 10% difference. So you kind of want to increase that year one so that you can gradually give yourself time to increase the economic occupancy. So whether that's collecting more rent or increasing rents, that way you have a little bit more of a buffer zone, and it helps excuse me, sinuses right now. It helps be more conservative with your underwriting as well.
That's a great tip, Jason. I just bumped it up to 14 just to see. We'll see what happens. I did like that the trailing 3 was 9.6, so that's what kind of gave me some hope, as opposed to trailing 12. But yeah, let's see what happens when we bump it up to 14. Cool. Okay. And then the last point I was going to point out here is that the cap rate, well, the pro forma cap rate in the OM has 8.3%, 831. It feels like, for like 8.3, that's like Oklahoma, that in Texas, even for C-class neighborhoods and properties in Dallas, what I was told 7.5 makes more sense. Even 7.25 makes sense. So I went more conservative with 7.5 here.
Also, what can help with your cap rate or your reversion cap rate is if you can talk to the broker and get a CoStar report, and then it'll show you the projected cap rates for that market year on year.
Hmm. Yeah, totally. I think that's a really good point. What's interesting about CoStar is that we do have financials from 2022. So there was an old listing. So we have a CoStar from August 2022. And what's interesting about the cap rate projection here is if you look at Dallas Fort Worth in 2024, let's say that's kind of where we are, it's like less than 5%. So I'm a little bit, you know, like I take it with a grain of salt, these cap rate projections. But yeah, it would be interesting to see what the at least like year one 2024 cap rate projection is for CoStar. But this is just an example that like it's just a projection. But yes, agreed. Good point. Okay, I think that's about it. And so where we landed was um right here. So thankfully, it didn't change this number too much. We're still at about 100%, even with the 14% year one occupancy, which makes sense, right? Because that's gonna allow us to implement our business plan. So we have these numbers here. Cool. So yeah, Jisoon, again, huge thanks for the letter of intent sample. This is what I did with it. I found out the name of the seller. We have this LLC. I offered 5.28, 25, sorry. So that's 79.5 per unit. And with a fully refundable 1% earnest money deposit. Yeah, that's kind of where we are. So I'm supposed to hear back today. See what happens. So super pumped. First LOI. Or Jason, what were you saying?
That's great, man.
We can't hear you well, Jason.
Oh, apologies. I was saying great job. You guys are doing fantastic.
Thank you, Jason. Yeah, it's our first one, so it's a little bit like let's just do it. Like even making a mistake here is better than not taking action at all because it's all refundable and whatever, and we can adjust the numbers later on via retrade or whatever. But still making progress because this is the first time we put in an LOI. We've underwritten so many deals, but this is kind of the first time we take the next step.
That's what's important, man. Being able to pull the trigger, have confidence in yourself. Don't get too wrapped up in analysis paralysis and just go for it.
Mm-hmm.
Yeah, if today they say they're gonna get back to us, and then they say, "Oh, we accept your offer," then what next?
Next, we're gonna have Jason join us in Dallas.
And Bob coming from
And
New
Bob
Mexico.
is exactly. We're meeting here next weekend is what's gonna happen.
Like go through the due diligence process and all of that is the whole process. A lot of deals doesn't make through the due diligence process, right? There's a lot of deals that when they find out something and then they fail to negotiate for that thing, then doesn't go through at all. So it's just part of the process, I guess.
Yeah, you're absolutely right. So like if when your offer gets accepted, you have about a 2-week period and you're supposed to use that time to start getting your legal counsel ready. So that way, once the PSA is signed, you guys can go ahead and start the due diligence process. And a great company that is, very prominent with the due diligence in the DFW area is Omni. So they'll come out, They'll do all the inspections within like the first day or two, and they have all the contractors that you need, and then they'll send you a due diligence report with all the information, and then you can also ask them for a value add plan as well. So any potential like value add items they can add on there, so that way you can help. That way that can help you with your capex budget as well.
You're on mute, Sophie.
So I'm gonna put the link here, the Omni group.
That's
Yep.
Brian Amos's group, correct?
Yep.
Yeah, he has a really good good reputation, does a lot of good work. So yeah, I agree with you on that, Jason.
Yeah, they did our due diligence for our deal in San Angelo, and man, they did a fantastic job.
Hmm. On the San Angelo deal, Jason, do you wanna talk about it now or on the next meetup when you can, like present or something?
Let's see. I can present. Just give me a moment to switch over to my laptop.
Yeah, so Jason, close on that deal, but also still raising money at the end and then updating it at the same time so we can see how it works with a deal like he closed, I think April, right? So
Yes,
um
April 9th.
yeah, yeah. And then you can show us how, you push up the management and change the management and push the rent, um and they increase the occupancy rate because that property, I think, went under contract, and then when they closed, the occupancy rate fell because the seller didn't care about the property at all. So there's many situation. Um, in the meantime, any comment, question? Andy, how was your week last week?
My week was busy. There was a lot of stuff going on, commercial and residential, and um, someone wanted to borrow money. I think two people wanted to borrow money, so I had to vet them also. Um, but yeah, so I'm working on that. And then I made contact with a bunch of brokers, and um, co- turns out that there's a lot of bloggers that has websites that has where you can search for their listing. And so there's a bunch of listing that I see. Some of them are pretty decent. I mean, the property looks really nice. I mean, almost like a C plus or B minus property. The question is, I have to dive into the financial to see if it's worth anything. If anything, the one thing I hate that brokers do is they said they have OM posted on the website, but they won't put the price. So almost as though I can't underwrite anything until I talk to them, right? I mean, why waste my time looking into an OM and then realize that it's 10, 20, 30 million and just way out the buy box. So I see a bunch of property. I, I can download the OM, but it means nothing until I call them. So I really wished at least they could put a ballpark number, right, or a range. Then at least I can quickly look at the OM and say, oh, out of range, I'm out. But now I have a bunch of listing, and every single one I have to call in, so it's annoying.
That's why they want you to call in. They do want you to call in.
Well, their time is precious, and I don't want to waste their time, just as I don't want to waste my time. But the way they do it, they'll be talking to tons of people, um, and right. So yeah. Mm.
Yeah, I think they eliminate the people who's not serious.
Uh,
So they know that you're serious when you call in, right?
yeah, yeah. Yeah. So yeah. So yeah. Mm, mm,
Hi,
It makes
Kwan.
sense. Hey, Kwan. Yeah, it makes sense, Andy. What I mean, you can do kind of like a rule of thumb, right? Like if it's like 200 units, probably it's too expensive. So I kind of like look at between 60 and 100, maybe 120, and then sort of kind of focus on those.
So so I'm part of a group in Austin, and they they're great at cold calling, meaning that to them, let's call the broker, get the price, get the motivation, get the story, get the situation, and then look at the financial. So because according to them, why look at the financial if sellers are not motivated or there's tons of competition, there's just no use overbidding in current market, things like that, right? So I'm part of a group that wouldn't want to look at any underwriting until they get the story with the broker first, and then they would underwrite. So they spend all the time talking on the phone every day. Yeah. Mhm.
Those are
Totally.
host.
Yeah.
Those people want a wholesale deal. So
Mhm.
that's what
Yeah.
wholesaler does. Yeah.
Yeah.
I don't
It-
see anyone in when I first joined Preston Rock Group. Um, we also think that we can go direct to the seller kind of method, and that's gonna help us stand out. It's actually not, and there's no one that like big commercial real estate investor do cold calling. They don't. They just talk through brokers.
mm,
Everything through brokers, and that's what professionals investor do. Yeah.
yeah. Mm.
So soon
Oh,
you ready?
yep, I'm ready. All right.
Awesome.
Oh, go ahead. What was you saying?
Awesome. So let us hear about this deal.
All right, too easy. Well, everyone, this is Cielo Vista. It's a 72 unit in San Angelo, Texas. We closed on this one April 29th. So this is being brought to you by Sunbelt Equity Group and FNB Multifamily Real Estate. Okay. All right, so you're gonna have your general disclaimer. It's basically saying that this is it's an offer, and we do have to, go with the SEC regulations and all that. And then we also have our financial disclaimer, which just basically states that it is an investment and there is a possibility that you can lose money on it, and you need to be aware of that. And I apologize, this is not the updated one because now this is no longer a 506B, it is currently a 506C. So we are accepting accredited investors only. And accredited investors will be verified through our CPA. All right, so let's talk about why we love this deal. So we were able to get this deal on a favorable loan assumption. So we have a great opportunity to leverage the debt that was already existing on the property at a low fixed rate. We also were able to acquire the property below replacement costs. And it's also in a great location. So San Angelo is very stable, has a very stable market, and excuse me, and it's just beautiful surrounding area as well. One of the problems before we acquired the property was it was being mismanaged. So mismanaged to them is bad, but mismanagement to us is good because we can come in, And like we've already done, we replaced the property manager. Also, they had a very high expense ratio, especially when it came to their, their monthly expenses, like their water and their sewer and their electric bill. So we come in and we find different ways of reducing those costs, such as using utility ranger so we can put the entire apartment complex on a RUB system. So then that way we can bill back the expenses to the tenants. And as always, remedial action. So because we are partnered with an experienced general partner team, any and all issues will be addressed promptly. All right, so let's talk about San Angelo. It's a stable yet growing market. So it has long-standing employers that won't soon be going anywhere. So we have 13,000 plus jobs. The average median income is 63,000, and we have a 21% rent to income ratio. So that's very good. That means people are making more money than they're spending on their rent. And we have large industries in the area to include the healthcare industry, manufacturing, mining, oil, and one of the top employers in the area is Goodfellow Air Force Base. And military installations, they're usually very stable, and you will rarely have issues with with military installations leaving the town or leaving the area. They're usually there for very long periods of time, if not forever. And the market also has a 3% unemployment rate, which is pretty good. Now we want to talk about the debt. So we were able to secure this at a 3.355 interest rate, so fixed interest rate until 2030. And this was a debt that was already on the property. And so we also have interest only until the end of September, which is the beginning of October of next year. And we're currently sitting at a 78% loan value. By the way, guys, feel free to stop me at any time if you have any questions. I'll be more than willing and happy to answer. All right. So the purchase price. So we got it aggressively discounted. So they wanted about 6.5, and we were able to get them down to 5.7. And in fact, upon further due diligence, well, not further due diligence, but because the seller wasn't doing what they were supposed to do and keeping up with the property, they let it fall by the wayside, and there were a bunch of uncollected rents. No one was in the office to actually collect rent, so it had a bunch of bad debt. So we were also able to get a $75,000 discount on top of that. So instead of paying 5.7, we actually paid 5.25. All right, the average rents at the property are 1,131 per month. Our total assumable debt was 4,498,000, and the previous expense ratio was 67%. So now we currently got it down to about 60, and we're working to get it around the 55% range.
Jason,
Yes.
on the assumable debt, how much time do you have left on that one?
Well, we have fixed debt until 2030. So 2030 is when the loan matures.
So the assumable debt matures in 2030, in about 5, 6 years.
Yes, that's correct.
That's great. That's long term enough for the business plan. That's great.
Exactly.
Wow.
Yeah, that's awesome.
Yeah. So with that time frame, you don't have to worry about refining because it's long term enough. That's awesome. Yeah.
Yep, exactly. And then once we've reached the end of our business plan, we're going to sell the property. And then at that point, we'll have made a 2x for our investors with about almost 10% cash flow.
Awesome. How did you determine what the replacement cost for an area is? I mean, you knew you bought it below replacement, but how did you figure out what the replacement cost is?
So the replacement cost is basically how much it takes to build that same type of unit in that area. So if you can figure that out, or you look at more of the more recently built apartment complexes in the area, like the other comps, and how much those are per unit, that's going to be your replacement cost.
Yeah, but how do you gather that data if you don't have CoStar? How do you gather what new units are being built at?
Well, there you can look at citydata.com, or you can look up the market reports that each brokerage gives out. So Marcus and Millichap, excuse me, give me 1 second. I can feel a sneeze coming on. Marcus and Millichap gives out a quarterly market report. And if you don't have a CoStar report, you can always talk to the broker and have them send you one as well.
I see. Um, do you know when the previous owner of this property bought it at? Like how many years ago?
Yes, they bought it about 2 years ago.
So, whenever I see someone who owns something for 2, 3 years, and I wonder, um, are they able to execute the business plan? Given the area, the location, something went wrong so that in 2 years they had to exit. Um, and obviously, every time I talk to brokers, they always give me a different reasons why it was such a short ownership, like 2 or 3 years. But sometimes I think about, hey, maybe the location, the area, you couldn't execute your business plan in that area even if you try to staff up the vacancy or maybe the crime, maybe there's no demand. So since it's such a short ownership, are you concerned that you won't be able to execute your business plan because someone actually tried it 2 years ago?
No, not at all. We are not concerned that we won't be able to execute the business plan. The reason for the short term, well, the short period of ownership in this case is because the owner was a bad operator. He wasn't taking care of his portfolio, and he got into some trouble with the tenants at his property and also with his investor base. And they kind of like fought back with him on that. And that put him in a situation where he was forced to sell and liquidate his entire portfolio because he was just doing bad business with with pretty much all of his assets.
Mm.
So it
So,
wasn't.
so even though he owns other assets and they were relatively successful up to buying this one, suddenly when this one came along, his skill set dropped off and all the other one had, I mean, how do you know he liquidated everything?
Well, couple reasons. So the brokers told us that he was liquidating his entire portfolio. They didn't tell us why though. We had to do our own digging and background research to find out exactly what was going on and what was happening. But
Awesome.
yeah, he had just been doing bad business for years and everything kind of caught up to him. And so it wasn't just his properties in San Angelo, it was also his properties in Seattle and other places around the country as well. And in fact, Tom Lafferty bought the bought the sister property to this one in San Angelo. He closed on it just a couple months before we closed on this one. The name of that one is Arroyo Square.
Tom is one of our coach in the Braxton Rock community.
Awesome. So in it seems like you're a good investigator. You're covering everything. In the end, was it helpful, or did you get a chance to talk to the seller before you purchased it, or everything was kind of through the broker and through networking of people? But were you ever able to talk to the seller before you took over?
No, we had zero contact with the seller directly. The
Mm.
everything went either through the broker or through the legal counsel.
Great, awesome. Buying from bad operating managers is a great find. I mean, that's where the money is. So great finding this one.
Oh, thank
Mm.
you.
Mhm.
But the cap rate and stuff, like I think you guys did a really good job on this one. Um, but do you think the cap rate still expanding in that market or the cap rate compressing?
The cap rate is staying pretty stable for this market. I believe they were selling it at a 6 cap. However, the market is like stably at 6.5% cap rate, and it's expected to stay around that range for the next 5 years.
Gotcha. Gotcha. Also, I think San Angelo is a stable market, but also heavily depend on oil and gas, right?
It doesn't heavily depend on oil and gas, and that's what makes it so stable because it's close to that area to where it has a large influence on it. However, it also has Goodfellow Air Force Base, and then on top of that, it also has a growing healthcare industry, and you have San Angelo State there as well. So you have a college there.
I see. College and healthcare. Uh-huh.
College, healthcare, military, and oil.
Awesome.
Sophie, Jason, expanding cap rate and compressing cap rate, sometimes I get confused. When you're a buyer or when you're a seller, which one do you really want? Kind of like if we buy now and we expect 5 years selling later, do we hope it to expand or do we hope it to compress?
You want the cap rate to compress. So you want the cap rate to get smaller. That way,
Okay,
when you sell your property, it'll be worth more.
okay, okay. That's standard. Like we want to buy at a high cap and sell at a low cap.
Yeah.
Okay. Okay.
All right, moving on. So, with the conservative approach, it's basically the same thing that all of us investors do every day or every week. When we underwrite or when we search for deals, we want to find a good one. So, in this case, we reviewed, it was at 76 or 78 deals before we found this one. And then when we found it, uh, we underwrote it about 10 different times, 10 different ways, just to make sure that it was a good one. And sure enough, it was. So it's just like Grant Cardone says, you got to underwrite 100 deals to find 10 good ones. And then when you put in your LOIs, you're probably going to get between 1 to 5 of those back. So it's a numbers game. All right, now let's move on to our sponsorship teams. So we have 2 teams here. So from left to right, we have, well, excuse me, this is Sunbelt Equity Group, and they are the lead GPs on this. So from left to right, we have Dr. Nita Jeromel, Dr. Oyinka Holt, Venkat Aramili, Raja, uh, Raja, Ritesh Baga, and Renato Germo. Right. So they bring over 50 years of experience in real estate, including acquisitions, asset management, and construction. They have acquired over 400 million in assets over the last 20 years and currently operate over 300 million in assets and 1,500 doors throughout the Sunbelt region. Sunbelt Equity Group strategically targets markets characterized by high demand dynamics to generate wealth for their investors through ownership and income generating multifamily properties. All right. And the second team we have is FNB, stands for Friday Night Billionaires, multifamily real estate investing. So from left to right, we have Antonio Black, Antoine Tonu, Isabel Puriette, and then you can see my lovely face right there on the right. So FNB is a powerhouse where discipline meets dedication. Our team blends experience from corporate America, the military service, and financial institutions, and forges a unique alliance. Our team is comprised of 2 corporate engineers with combined experience of over 22 years in corporate, alongside, well, it's now 12 years that I've been in, and also a proven enabler. We bring a wealth of expertise. Our vision is clear: to touch, educate, inspire, and empower humanity through real estate, securing financial freedom and generational wealth. Trust forms a cornerstone of our mission as we create value for investors and communities through exceptional multifamily properties, fostering prosperity in the neighborhoods we so proudly call home. All right, and now we move on to the property overview. So it's 72 units, built in 1968, comprised of 11 buildings, and I believe 9 of those buildings are 2 stories. The only buildings that are 1 story are going to be the leasing office and the maintenance building that is attached to the pool or the clubhouse. All right, sits on just over 5, just under 5.5 acres. And it was 92% occupied before we purchased. Since the seller wasn't taking care of the property, the occupancy rate actually dropped down to about 75%. And that was while we were under contract. And since then, we have gotten the occupancy back up to about 86% as of this month. Oh, excuse me, as of August. Current rents are still the same. We won't be raising rents until next year. So as the leases start to expire, we're going to be implementing $25 to $50 rent bumps. So that's going to increase our NOI on the property. And I'm gonna touch on this right now, but I'm gonna explain it more as we go along. But the average unit size is 1,026 square feet. So that's one of the beautiful things about this property. It has huge units. All right, so here's our opportunities to, for value add. So we're gonna reduce expenses, which we have already been doing well. We've implemented water conservation, and we also put the entire complex on a RUB system, as I mentioned earlier. So we use Utility Ranger, so we pay for everything up front, and then we bill back the tenants for their utilities, and we charge them for doing this. So that adds income to the property. All right, improve the management process. So we already got rid of the previous property management company, and we've implemented or hired a new one, and these guys are doing absolutely incredible. We are getting nothing but positive feedback from the tenants. We've also fixed the pool, so now the pool isn't green and swampy. It's nice, bright, pretty blue, and the kids love playing in it. And the tenants are happy that they can go to leasing office and there's somebody there that they can talk to and help them out with whatever they need. What we're currently working on right now is transforming the property's exterior. So with that, we're starting off with the parking lot. So we're gonna fix the cracks in the parking lot, make it look all nice and neat, put new paint out there for all the striping. And then after we're done with the parking lot, we're gonna move on to the fences. So some of the fences, the wood is beginning to come off. So we're gonna go ahead and replace those so the tenants can be all happy, and it makes the property look nicer and more walkable as well. We also have a plan to modernize existing amenities and facilities. So just to make the area just a little better. You walk around and it's like, this is nice. And so to do that, what we're gonna do is start off with the common areas, improve the lighting, and also improve like the grills, so the tenants can come out, cook food, and have a good time. And as always, we love our remedial action. So if we find any issues, we're going to deal with them promptly and swiftly and find an effective resolution to enhance the financial performance for our investors.
Jason, quick question. So you found this property manager that you work with right now. It's not the old property manager, right? And you found a new one and they've been really good.
That's correct.
And do you work with them like twice a month, every week? How do you guys schedule the asset management call with them?
So for us, we have, in fact, it's actually today. So every Tuesday afternoon, we have a call with our property manager, and usually the owner and the regional manager are also on the call as well. And we just basically go over everything that's going on the last week, what went good, what went bad, where can we improve, and these are the things that we need to get done.
Makes sense. So if you have 7 properties, you're gonna have
We
7
have
calls.
7 calls. Yeah, that is true. That is true.
It's good that
Now,
you can do Zoom, right? Like,
yeah, that's how we do it. Zoom and Google Meet.
yeah, awesome.
So Jason,
Yes,
to continue with Sophie's thought, so there's the property management and there's the assets management. You're doing the assets management. You're only asking your PM to do the property management, which is basically groundskeeping and tenant and leasing, right? But any of the cost cutting and any of the capex and stuff, you're doing that yourself, correct? Your GP is doing that.
that is correct. So we just manage the property manager, and we do well, they come up with a budget for the property as well, but it has to be in line with our budget. So at the end of the day, whatever the GP team says goes, and it's up to the property manager to get it done or get replaced.
Okay. So two questions. Given that the PM in a what do you call when you're trying to buy a distress and then improving like in the beginning of this on the year one performer, what are you paying the PM for year one? Given that on year one they're working twice as hard because the property is not stabilized. What are you paying the PM right now
We're paying
for
them
them
three
to work year one?
We're paying them 3%, and that's how we're going to keep it. So the better that they do, the more that they get paid. So the more rent that they're collecting and the higher the rents are, the more that they get paid. So they take 3% of the gross monthly income. So the more that the property makes, the more goes into their banks.
That's great. Okay. Okay. Did you struggle to sign them at 3%? I mean, it's 3%, so you didn't offer them like 4 or 5, 3 o'clock, 3%, and you felt that the money was worth the quality that they took it right away.
No, not at all. So 3% is basically industry standard. So you're going to see about 3 to 5% with most property managers on assets that are typically 32 units and above. So anything smaller than that, your property management company is going to charge more. So like with single family, you'll see property managers charging 7 to 11% of the monthly income.
Yeah. To ensure that this thing succeed, did you decided that you needed an on-site live-in manager and maintenance guy, or is it off-site?
Right? So it's definitely on site, and that's honestly the best way to do it. Now, currently, our leasing agent does not live at the property. However, she likes it so much that she wants to rent there. So we're gonna let her do that, and we're just gonna give her a concession on top of that, so she has her employee discount. But yes, I highly recommend having on-site. One, it puts the tenants at ease, and you have someone there to always take care of the property and make sure that things are getting done.
Yeah, that is amazing. Like I think that is one of the tip that I mean if you have great people and they live nearby it's fine, but that's one of the tip that people like Sandia in the community they also do. They find a good people who lives on the property to work as a leasing at the leasing agent or the maintenance person. So they have eyes and ears on the properties all the time.
Is the leasing agent different from the property manager? Or kind of like the property manager said, I'm doing the leasing, obviously doing that, but is that two different person, the PM and the leasing? Because I know the maintenance is different.
So the PM is the company itself. So the maintenance personnel and the leasing are all under the PM umbrella. So typically you're gonna operate, we'll decide depending on the size of the property. Like for this one, you can operate this one in, one out, which means one person in the leasing office, one person doing maintenance. And the larger you go, you'll start seeing like two or three in and then two or three out, because obviously bigger property, you're gonna need more people.
And your leasing person wants to live here, but what about your maintenance guy? Because he's kind of important too, right? The bigger, does he live there for you?
No, our maintenance personnel does not live on site. And honestly, that's up to you as an owner. If you want to let your um employees live there. I mean, and you also have options as well. So you can choose to give them an employee discount or not. They can pay full price, or you can give them a discount.
And that employee, he's basically on salary. He works 24/7, or he only work 9 to 5.
So they are on salary positions and they can get overtime. And they
Okay.
do have, they have like your typical hours. However, if something, an emergency were to happen, then then they would have to come in.
Okay. Mm.
That
That's
should
great.
be
Thanks, Jason.
that should be in the contract, right, Jason?
Yes, that is also in the contract. Well, the property management contract, to be specific, yes.
Yeah.
Hey, Phillips and Kevin, I noticed you guys joined late, but would you like to introduce yourself to the group? And you have your camera on if you can.
Oh, I'm sorry about that. Yeah, I'm Phillips. I'm just brand new in this, so I'm looking to learn from you all. And thank you for inviting me to this call.
What's your real estate background, Phillips?
Well, I was a real estate broker for 10 years back in California. And I moved here to Texas 5 years ago. So right now I'm pretty much a real estate investor for single family homes. And I also have my full-time job as a software engineer. And I invest in stocks and all kinds of stuff. So yeah,
You in Austin?
I am in Austin, yes.
Awesome. Andy's in Austin. So
Oh, cool. Hi, I'm Andy.
Oh, hi. We should catch up and meet up and even talk about stock market. I still have to manage all my stock portfolio. I need as much advice and from you if I can. Let's meet up someday.
Yeah, sure. I don't know whether I can give you advice, but yeah, let's catch up. I also
Okay.
invited Andon Lay, but
yeah, Don Lay.
I don't know whether he's going to be able to join.
Maybe he's busy. Yeah.
Okay, yeah.
Thank you, Phillips, for sharing. Kevin, are you here? Would you like to introduce yourself to the group? I asked you to unmute Kevin, but maybe he's not here. I don't know. I hope he's not one of those bots. Like there's sometimes some bot just joined my meeting, and then things got weird. I think I got last time like that.
I'm about the same.
Sasha supposed to manage our stock portfolio too, but he basically not do nothing.
It's a strategic decision.
Listen to Warren Buffett and not doing anything.
That's right. Sorry,
Jason,
Jason,
you want to
you want to
continue?
keep going?
Yeah, sure. So next, let's talk about the floor plans here. And as I mentioned earlier, these are really spacious. So, well, really spacious for the market. So we have the largest units available in the San Angelo region, like within the 3 to 5 mile radius. And we also have a comp comparison to show you that later. So this property has 1 bed, 1 bath. We also have 2 beds. We have the 2 beds come in 2 different models. So we have a 2 bed, 2 bath, and also a 2 bed, 1 bath as well. And then we have our 3 bed, 2 bath. So the community amenities, we have a swimming pool, an off-leash pet park, a fitness center, and a laundry facilities. Now, the apartments do also come with washer and dryer hookups as well. For the unit amenities, we have white appliances, two-tone paint, refinished countertops, balconies in select units, and also fireplaces in select units.
So, good question. Do the 1 bedroom units have central air, or they window ACs, or how are they called?
It's all central air. So here you can take a look at some of the pictures that we have. You can see at the bottom left-hand corner that the fireplace is in there, and you know they're pretty nice. So even though this property was built in the 60s, it's still a very good looking property. And as far as maintenance goes, it's been pretty well maintained. So there's no major issues with the property whatsoever. All right, now let's talk about our property management company. So we chose Ints Realty and Property Management Company. So they manage 3 similar properties. Well, actually, now it's like 5 similar properties within a 10-mile radius. They have more than 700 units under managed currently, and they have about 6 years combined experience in manage of multifamily real estate. They also have a very strong track record of management across several markets in Texas. So how we found these guys is actually through the broker. So the broker has worked with them before, and you know, since San Angelo is a tertiary market, it's kind of difficult to find, you know, good property management companies, because you know it's not a major MSA, so there's no like who's the RPM? RPM is a really good one. They're nationwide. So they don't have like a property management company, like a large property management company in the area. So we got a couple recommendations from the broker. We called and we vetted all three, and Int's property was the best of them. So we went with them, and they're proving that they were the right choice. All right, now let's talk about our comps. So Cielo Vista is on the top, and then we have 5 other comps within like 3 miles of Cielo Vista as well. So let's start off with our 1-1s. So we're definitely seeing the larger floor plans with Cielo Vista. The only one that has a larger floor plan for the one bedrooms is the El Conquistador. So with Cielo Vista, we're still at a competitive price. So as you can tell at Bella Vista, they are offering 600 square feet for 875. With our one bedroom, we're at 768 and you get more space. With our two twos, I mean, we're pretty much unbeatable there. Yes, we have the highest rent, but we also have the largest floor plan. And the rent is very compatible as well. You can go to Bella Vista and for a two bedroom, one bath, you're paying 1100 for 800 square feet. You come to Cielo Vista, you pay $200 more and you get 300 more square feet. So you're definitely getting the most bang for your buck.
What's
And
the
oh, go ahead.
Jason? Sorry, what's the age for these comparables uh, apartments that you have here?
Most of these comps were built in the 60s and early 70s. I believe there's one which is the El Conquistador that was built in the early 80s.
Yours a little bit older than those, but get upgrade, right?
Yes. Right. So with our two twos, it's basically the same story. You're getting more bang for your buck. The only one that can compete with that would be Harvard House. And Harvard House is actually, well, was actually in the same portfolio, but the financials for Harvard House didn't do as well as Cielo Vista and Arroyo Square. And then
Jason,
yes.
Jason, why is your 2-2 renting less than your 2-1?
Well, that was just the current setup. So as we progress with our business plan, we're going to be increasing the rents.
Okay.
So currently we can't do anything until those leases expire. So once those leases expire, then we're going to be able to increase those rents.
Great.
And then finally, we have our three bedrooms. Now, our three bedrooms, best in the area because we're charging 1,400, but you're also getting 1,400 square foot. At Bella Vista, you pay 1,350 and you get 1,000 square foot. All right, so now let's go over the investment details. And once again, I do apologize since this is not the updated one, but our investment type is currently a 506C. So we're accepting from accredited investors only. All right, the asset class is a C plus or a C, depending on how you want to look at it. Our investment strategy. So we've already purchased the property and we're gonna hold it for 5 to 10 years or less, depending. So if we can implement our business plan well enough and we can achieve a 2x return to our investors in 4 years, then that's what we'll do, especially if something happens in the market. All right, so we have already improved the property management and we're going to increase rents and implement our targeted CapEx plan. As I mentioned already, our projected hold time is 5 to 10 years, depending on the market, but if we can do it in 4, we will. Our minimum investment is 50,000. And we're doing a straight profit split. So it's going to be 75-25. And the PPM will have all the details. Now, our targeted returns, we have a 22% ARR and an average cash flow of about 10%. And at the end of anything, we're looking at about just over a 2x multiplier for our investors. Now, our distributions are going to be paid quarterly, and we're going to be starting those this month. For tax advantages, we're going to be doing a cost segregation study. So our investors will be estimated to receive a 25 to 45% depreciation bonus. However, and I need to get back with you guys on this, but we should be able to get more than that depending on the bill that was passed. So we may be able to go back up to 100%, but I will get back to you guys on that. All right, so here are our investment projections. So this is going to be based on a $100,000 investment for simplicity. So if we look at our capital balance, that's going to be your investment. So your investment doesn't change. It's going to be $100,000 the whole time. Now we go to our distributions from operations. So this is going to be our yearly cash flow. So from that $100,000 in year one, you should expect about $11,000 back. In year two, it's going to drop to 9,500, and in year three to 9,300. In year four, you're going to get 9,900, and year five, $10,000 back. Now, the reason for the decrease in years 2 and years 3 is because after year 1, we now have to pay principal and interest because our interest only period will have expired. So after it expires, we raise rents. Well, we're going to raise rents anyway, but by raising rents, we're going to increase our cash flow year after year. So that's going to bring your average cash flow back up. Now, as we can see, your average cash on cash is about 10% throughout 10% per year throughout the holding period. So year one, you're going to get 11% back. Year two, 9.5. Year three, 9.3, and so on and so forth. So at the end of 5 years, all of your capital will be returned. You will receive a $63,000 profit from the sale according to the splits. So your total cash flows are going to end up being 73,000 from the cash flow. So you'll have your profit from the sale and your cash flow on top of getting your $100,000 back, which gives you a total return of 213,000. Now, our projected IRR is about 18%. Our average annual return is about 22%, and our equity multiplier is about 2.14%. So if you give us $1, we give you $2.14 back in 5 years. Now, on top of that, we also gave a sensitivity. We also came out with a sensitivity analysis. So we picked 3 major KPIs. So that's going to be our economic vacancy, our stabilized rent growth, and our exit cap rate. And what we did was we played with the numbers and we stress test the property to ensure that it can perform no matter what the market throws at us, unless if it's an act of God or we go to war or something crazy happens. Then that's out of our control and we'll have to adjust with it. So our baseline is going to be our current 10%, right? So if the economic vacancy were to change, if it goes lower, our AAR and our cash on cash will both increase. As the economic vacancy increases, our AAR and cash on cash decrease. So as you can see, at 7%, we're still hitting at 23% ARR, and on cash would be 11%. At 13%, 19, and then 3. So either way, you're still doing pretty good with this property. Next, let's talk about our stabilized annual rent growth. So that's how many people are moving in and moving out of the city. Now, San Angelo is a very stable market. You don't have too many people coming in. You don't have too many people coming out. So the numbers aren't going to change that much. So our baseline here is 3% year on year, and that's rent growth. So every year, we're going to be increasing the rents by about 3%. All right, and that's just a $25 to $50 rent bump every year. And then finally, we have our exit cap rate. So that depends on the market. So right now we're currently sitting at a 7%. So we're on a pretty decent end. So if something were to happen in the market where the cap rate would expand, then we're going to see a drop in our AAR. However, if it compresses, we're going to see an increase. And if we can sell it for more, we definitely will. All right. Next, we have our capital improvements. So we're going to budget for exterior, our amenities, and our interiors. So for our exterior, which are going to be things like our paint, our parking lot, the fences, the pool, and the lighting, and also landscaping if we need to, we are budgeting $200,000. For our amenities, which also includes the pool, the common areas, the gym, and the laundry areas, we're budgeting $100,000. And for our interiors, $250,000. So a total of $550,000 is going to be budgeted for capital improvements, and that's about $7,000, just over $7,500 per door. All right, now let's dig into our fee structure. So we want to be honest and transparent with everything that we do here. So as I mentioned earlier, we're just doing a straight split. So it's 75-25. So all the income that the property makes gets split, 75 going to the limited partners and 25 going to the general partners. Our property management fee is 3%. Our asset management fee is 2%. Our acquisition fee is 3%. And our capital transaction fee is going to be 1%. So capital transaction fee is repositioning the property. So whether we refinance it or put it in a position to sell, we still need to do the work to make sure that that happens. So we're going to charge a 1% fee to make sure that that gets done. All right, next are fund sources and uses. So for our fund sources, we have our loan amount and our investor equity. Our loan amount is $4,498,000. Our investor equity is $2.5 million. Now, currently, we are sitting at $2 million, and we have about 500 remaining to raise, which brings our total sources to $6,998,000. Now, our fund uses are as such: a purchase price, $5.7 million, closing costs and fees, $375,000, and our repairs and reserves are $923,000, which brings our total uses to $6 million, $998,000. So our fund sources and our fund uses match and are aligned. Now, our investment criteria. Once again, I do apologize. This is no longer a 506B offering. This is now a 506C offering. So we will only be accepting offers from accredited investors. We accept cash, SDIRAs, solo 401ks, and EQRPs. Our minimum investment is $50,000, and investors will be accepted on a first funded basis. So once we reach our target capital raise, we will no longer be accepting investments. The investment process is simple. So you review the offering, make sure that you review the documents and commit through the investor portal. The link is going to be included later in this presentation. Now you sign all of your documents electronically through the investor portal, and we use cash flow portal. Funding, you're going to use the investor portal to send funds by ACH or wire. Pay no attention to the dates. We are still raising for this. And closing was in March. Excuse me, I apologize. I'm reading off the screen. We closed April 29th. So the property is already closed. We're just finishing our capital raise. Now, finally, the last question is, are you in? You got to commit. So if you are, log into the investor portal, create an account, access the portal, navigate to the deal room, and view and review the marketing materials. And that's where you're gonna sign off on all your documents and get updates about the investment. Next, you're gonna e-sign the documents, view and complete all the legal documents inside the portal, and then you're gonna fund. Now you can use the link on the right-hand side, and that is going to lead to my team's portion of it. If you use the link on the left side, that is going to be the SEG teams. All right. And then we also have our frequently asked questions. So, can I use SDIRA funds? Yes, you can definitely use your SDIRA provider as long as they allow for it. So make sure that you're following the proper rules for that. And if you need to, please reference the PPM as it specifically discusses how to invest with your SDIRAs. When do distributions start? So we're actually going to be starting distributions this month. What are your projected annual rent raises? 3% per year. So that's about $25 to $50. How often will updates on the deal be sent out to investors? Every month. We have a monthly newsletter that we send out to all our investors so they know exactly what's going on with the property. So, and like I mentioned earlier, we are always honest and transparent. So if the property is not doing well, we will share the news. If it is doing well, we will share the news. If nothing changes, we're still sharing the news. And then lastly, how do I get tax advantages? So as an investor with us, your investment will go towards equity ownership of the property. So that means that you're going to receive a K-1 at the end of each year for your investment with us, and you'll be able to access these documents from Cash Flow Portal as well. All right, that is the end of the presentation. If you guys have any comments, questions, or concerns, let me know.
Jason, I have a quick question. I saw in a couple of slides you mentioned that the maintenance budget is 500K, but then on the following slide you mentioned that there is the 900K maintenance in your capital. So this is one of them, right? So this is a 500K, And then, yeah, this is another, what's the difference here?
So the 500K is going to be for the capital improvement. So that's all like the maintenance exteriors that we're going to improve. Now, we also need another 400K for our reserves. So our reserves is basically all the money that we have sitting in our operational account to make sure that we can operate the property.
Okay. Is 500K, is that like a generous budget, or is it like kind of minimum, or what's, because I think 500K might not be enough, right? Because the property was built in 1968 or something like that. So
Yes,
there
that's
must be.
so for the area, it's fairly decent. It's fairly decent. We're not using too much, but we're not using too little. So we did take into account that it is an older property. So we wanted to make sure that if something does go wrong at the property, we have the budget to be able to fix it.
Okay.
Yeah, it's a good question, Phillips. I think it's in the world of single family, right? This is similar to not over investing or over fixing, right? Because you don't want to spend on things that actually don't raise NOI in this case. So I think that's Soon's and that team, like they probably went through a lot of the things that they could improve, but probably eventually landed on only the things that they want to improve or plan to improve, right? Because you could improve so many things. But it's important not to overspend as well.
Yeah.
Yeah, absolutely.
And I know I joined late, so what's your team's experience in this? Like I think I joined at a slide where you mentioned about your name and a few other folks, but what are yours like credentials and experience and reputation? Is there anything I can look into that a little bit?
Okay, absolutely. So for us, this is our team's first deal. So
Okay.
for me, I only have, well, prior to this, I only had experience with single family homes. So I had four, one in Vegas and three in Georgia.
Mm-hmm.
Um, Antoine and Isabel, they're both married. Their background before this was in corporate America, and they also own properties in Florida, also single family, and they were doing some Airbnbs
Okay.
and so renting some of theirs out. Antonio, his background was more in what was it? How do you say it? It funding. So he helped people get funding for banks and businesses. So that's where
Oh,
his experience comes in.
okay.
Now the SEG side, these are definitely more of our experienced partners.
Mm-hmm.
So Nina and Renato, which are the far left and far right, they're married and their background is in construction. So they've built a lot of homes and buildings. And they also own how many units? I think Renato has about 800 doors under management. And then Dr. Oyinka Holt, she's experienced, and I think she has like 4 or 5 deals that she's currently managing right now. And then we have Raj or Ritesh. He's on the top right. So he owns properties in was it he I know he has one in Wichita Falls. He loves the DFW area and he has a couple deals there as well. And
Okay.
then we have Venkat and his sister Raja. Those two are like the top heads of Sunbelt Equity Group. And they're the ones who have most of the firepower. So they've got like thousands of doors under their belt, and they're always looking for more deals to purchase.
Thank you.
You're welcome.
Jason,
Yes.
hey, so the sponsorship team, they get you to the finish line of the closing, but then after that, um, do they do anything more? I mean, after the closing?
Absolutely. So we're all in this together. So on the F&B side, it's us, and then on the Sunbelt Equity side, it's them. And we are in constant communication. We are all on the property management calls on Tuesdays, and then on Wednesday mornings, we have our team calls where we discuss, things that are related to, the property and how to deal with certain situations or things that we need to come together as a group with and decide is best for the property and how to communicate that to the property manager as well.
So after the purchase closing, you're saying that they will stay on as advisory all the way to exit, like 5 year exit?
No, so they are active. Everyone is active. So we are all currently working on this deal.
So
And
they
we're
hold GP, they hold GP equity shares, and they you plan to have them. So they hold equity shares. Is that true?
yes, everyone does.
Okay. Okay. So they'll be active until like 5 years from now. That's what you
Yep.
were saying.
Yes, everyone on both sponsorship teams will be active for the entire holding period of this investment.
Great, great, thanks.
Okay, my other question, Jason, if you don't mind.
Yeah, shoot.
Yeah, I noticed that you have one slide where you mentioned that there are additional fees. Are those fees already be taken into account in terms of the distribution, or are they additional? I'm talking about, yeah. So
Can you
these are
say yes?
so these are additional, right? So let's say, let's say I got, let's say you mentioned like what is it, 11%. So that would be around, if I put in 100K, I would get about somewhere 1,000 and something, right? And then so then on top of that, you guys also need to deduct these fee out, right? So that's
No,
another.
no, there is no need for those fees to be deducted. So, well, out of your investment. So how this works is let's start with the profit split. All right. So
Yeah.
all the profit that the property makes gets split 75-25. Now that's cash flow, and that's also the profit made at the sale. Okay.
Okay.
75% of that profit goes straight to the limited partners. And us on the GP side, we only get 25% of that.
Okay.
Now, the property management fee, that is monthly, but that doesn't go to us. That goes to the property manager. So they get 3% of the gross monthly income for operating and managing the asset. The asset management fee goes to us. So that is a monthly fee that we charge for managing the manager and making sure that the asset is performing well. The acquisition fee is 3%, and that's one time. So that is for us so that we can sort of recoup some of the money that we paid upfront to get the deal. So that's pretty much like how, I mean, not our reward, but so kind of like a reimbursement. So when it comes to getting the deal, we have to pay all the upfront costs. That includes the earnest money, that includes the legal fees, that includes the fees for the due diligence, and any other
It's,
fee
yeah,
associated.
it's your work. But I guess what I'm trying to get down to this is that let's say if door to door, each door generates, let's say $1,000, right? And then y'all take like, okay, 2%, and then the other property man, that's 5%. And then there are some other fee like maintenance, blah, 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 right? So minus a bunch of other money. So what is this X amount here? You know, like what the approximate X amount here that will be at the end will be distributed to all the limited partners.
Okay, I understand what you're saying.
Yeah,
So
I'm just trying to get that idea because right now 75% doesn't mean anything to me at all. It could be $100 times 0.75. That would be like, what is it, $25 left for me. But if I were to put like a 50K and I get $25 per month, then I don't know whether or not that's a good deal or not, right?
okay, I understand where you're coming from, Phillips. Let me see if I can alleviate some of that. So let me pull out my calculator real quick. Okay,
Yeah, right
so
here. So you got right here. So like, okay, so $11,000
per year.
per year, right? And out of this, are you gonna take anything out, like,
No.
operational cost? Okay,
Oh,
yeah,
that all goes to the investors. Now, if you have, let's see, all right, so the 11,000, that's going to be your yearly distributions. Now, we're going to be we do quarterly distributions. So you divide that by 4. So every 4 months, you're going to get a check for about 2,700, almost 2,800.
mhm,
But Philip, maybe another way to answer that question is that the numbers you're looking at here are they are the 75%, right? This is after that split. So when we're talking about returns to investors, investor is the LP. So the numbers you're looking at, it's after that split. It's after the calculation.
yeah, okay. But this is projection, right, Sasha?
Yeah,
So,
always a projection.
but
Yeah.
yeah, the reality is there can be something that will be built into this. So that's why I'm trying to figure out. I'm like, maybe just get a ballpark, projection of what can be built into this $11,000. What can be deducted from this?
No,
No.
this nothing. So what Jason is saying is basically that there's no hidden fees here, right? So the fees that he's talking about, they've already been deducted. So every single fee that we looked at in the previous slide, so this is the number that's gonna hit your account after all the fees have been deducted if we perform exactly the way this says we perform.
Okay. All right. I think that's all I need to ask. Thank you, guys.
Right,
Yeah,
you're very welcome.
of course. You can read Phillips. The way to understand it more is to read more of the offering like this. For example, people wanna do a deal and then they send out all of this to investor. So like the projection, what is the preferred return, what is the split, what gonna happen first, what gonna happen later. So sometimes we got confused because single family real estate is kind of like straightforward, but in commercial real estate, there's a lot of new terms that we have to like kind of ease into. Like preferred return. What is even preferred return? What is the cash flow here? Um, do you also get part of cash flow, or should investor should get cash flow first? There's a lot of question that you can ask when you read the OM. So when you read the offering memorandum like this, kind of like what Jason present like this, if you don't understand how it works or anything, feel free to reach out. Always to have always happy to help you to learn some of the terms and and understand how this works.
Yeah, thank you. Hey guys, thank you so much. I got another
Yeah.
meeting. Thank you.
Awesome. Awesome. Yeah, I think we're about to end as well. Thank you so much, Jason, for presenting us the deal, and look like you guys doing really well. Congratulations.
Oh, thank you. Thank you. Much appreciated. And also thank you for letting me present on your platform.
Of course.
A great
Yeah.
deal.
Yeah. Awesome. Great deal. Great underwriting, Jason. And
Well, thank
management too. Yeah. Thank you, Bob, Andy. Thank you, Sasha and Kevin. Yeah, so Jason can send this to Sasha. Another thing Andy was asking is the self-directed IRA, right, Andy? Like you want to find, you want to talk to someone who have a self-directed IRA and draw it fast and stuff. So, and you want to learn the UBIT for that, right? We can talk about that later. I also use my self-directed IRA, but it's Roth. And I recently learned that self-directed IRAs is not really good when you invest into apartments. The better vehicle would be solo 401k. So you can roll your self-directed IRA, not Roth, into the solo. You would not get tax UBIT. But if you use your normal self-directed IRA, you would get taxed.
Yeah. I know about that the solo 401k is a much better vehicle. You can borrow debt and as investment, and you don't have to pay that tax, the UBIT tax. I'm not sure about the depreciation though, but we can talk about it on the side.
Yeah, awesome. Yeah, thank you
Awesome.
everyone. And great seeing you here. And hopefully we have great news today from the broker. If not, we keep going. Bye,
Yeah.
guys.
Thank you, everyone.
Thank
Good
you.
luck.
Thank you,
guys
Jason.
Bye, Jason. Yeah,
welcome. Thank you.
Mm.